Did you know Americans change jobs an average of 12 times in their lifetime, and often they have retirement money at each one?
Welcome to another episode of Millstone River Live, a podcast brought to you by Millstone River Wealth Management.
Adam, good afternoon.
Good afternoon to you too.
Today we're talking about reasons someone might want to consolidate their retirement accounts.
Oh, sure.
Yeah. So this is something I think you like to talk about, and maybe I could ask you a few questions and we can help our listeners with why they might want to think this through.
Yeah, let's give it a shot.
All right. So, if someone has changed jobs, often they leave a 401k account with the prior employer, right? And they're busy with the new job, getting acclimated, finding out where the restroom is and learning their new schedule and what have you. Sometimes it can be overwhelming and you forget you have retirement money left behind. So how do you keep track of that? What do you do?
Yeah, I think anytime there's a major change in your life, especially when there's financial considerations like a new person paying you and different benefits and things like that, it certainly is wise to take a step back and just reevaluate, what it is that you have, and most importantly, what do you think about for the future? So one thing that we suggest when you do change jobs is it is an opportunity that both your past employer, your current employer, as well as if you have individual retirement accounts, it allows you to consider whether consolidation makes sense. And there's a variety of reasons why sometimes consolidating retirement accounts is wise. But one of the simplest one is it's just easier. If you think about it, every single retirement account has its own login information, its own statements, its own different investment lineups. There can be different fees associated with each one. It's just a little easier to track when it's all with one relationship. Now, Matt, myself, we provide different technology tools that can sometimes allow you to aggregate information at different firms together in one place. But those are still all separate custodial relationships that have their own rules, their own logins, and having it all in one IRA or one relationship certainly makes it a little easier.
So consolidating might make it simple to track progress, might make it easier to track yourself against goals, and maybe even keep track of your investment performance.
Yeah, exactly. Another byproduct of that sometimes may occur is each firm sometimes has their own fees associated with it. So sometimes consolidating to one account can actually lower your overall investment management expenses or fees. It's certainly also, if there's any firms in which they tier how they charge, meaning that for a larger account balance, they charge slightly less for the same level of service. All those things can sometimes be accomplished when you do decide to finally consolidate.
So maybe putting those accounts together, you'll hit those higher thresholds, and then that reduces your cost, and less paid in fees is more money for your own account, right?
Yeah, exactly.
All right. That sounds good. In terms of simplicity, a lot of people are trying to declutter. So how does that work if you're thinking about consolidating old retirement accounts?
It obviously makes it a lot easier for you, your loved ones that own the accounts. It makes it easier as an advisor to have the full financial picture to be able to provide guidance. But one thing that we sometimes lose sight of, but I certainly think it's important, is it can also be a lot easier on your loved ones, your family, because one of the features of a retirement account is that you have a listed beneficiary that says, if something happens to me, where should my assets go? And for every single registration that you have at a different custodian, in the event that you pass away, that means that your loved ones has to not only be aware that the account exists, which in some cases, the days of going paperless, if you're not organized, you may let a small account, out of your line of sight. But then they also have to do basically a death claim. They have to go ahead and process for each single registration. We've had clients that have direct ownership in stocks that, believe it or not, have had to gone through that experience for their loved ones for 40, 50 separate accounts, all with their own paperwork, all with their own rules. And from our perspective, if you can avoid that, that is definitely a plus to consolidating.
So it's simplicity, but then also it sounds like you might alleviate the need to be chasing down account statements or 800 numbers or website logins, and just make things easier for your family or your heirs, right?
Exactly. Some firms want original death certificates. Some, want, estate documents signed. And, the last thing you want to do is burden your loved ones at a time when, potentially they're, mourning your loss.
So maybe you have one more question we could ask before we run out of time on this podcast episode. So people ask often about RMDs. I think there's a lot of confusion out there about what is an RMD, why do I have to do it? Well, maybe you can help our listeners a little bit with sort of what's the RMD and how does consolidating your retirement accounts help in that vein too?
So to define what the initial stands for, RMDs are required minimum distributions. For a retirement account, so these are traditionally pre-tax contributed retirement accounts, like traditional IRAs, SEP IRAs, et cetera. When you reach a certain age, if you have not started taking withdrawals, which when you take a distribution, it becomes a taxable event, which means that there may be a federal or state tax liability that's owed because you took a withdrawal and it was added to your income. The government, which gave you this benefit and a certain tax benefits to save in these vehicles, but it's their way of saying, all right, well, we want you to start using them because you've never paid taxes on them, and this is their way of the bill, creating that taxable event. Traditionally, a couple years ago, RMDs would have started at the age of 70 and a half, the year that you turn that. Now, because of recent legislation, that is moving towards 73, and by the end of a decade further, it may be all the way up to age 75. But it just means that you now have a responsibility based off of how much each retirement account is worth and your age, a minimum amount that you have to take out in order to avoid a pretty hefty tax penalty. So it's definitely important that you're satisfying your RMDs. And maybe the last reason I would bring up today that consolidating makes sense is it just simplifies that process. When you have one relationship, you can set up instructions so that it goes automatically. There are certain investment vehicles like annuities that sometimes have their own rules as to exactly how a required minimum distribution is taken. You don't have to take the RMDs out of each account that you own. It just is a collective amount that has to be calculated and satisfied every year. And it's just a much simpler, less stressful process when you know exactly what that amount is going to be the first week of January every year.
So if I have either one retirement account or multiple, but I fail to take out the appropriate amount, I mean, why do I care about that?
Well, that's that penalty I was alluded to. And for every amount that you don't satisfy, unless you can unless you can apply and are given an exemption, the tax penalty could be as high as 50%. So it's something completely unnecessary, and you want to avoid at all costs never satisfying that requirement.
So it behooves you to make sure it's done and done right. Consolidating your accounts might make that easier to do, and maybe even to sleep a little soundly because you know it's being done properly.
Couldn't agree more with that statement.
So there's 4 reasons to consider consolidating your retirement accounts. If you want to know more, we'd be happy to talk with you about that and see whether it's appropriate for you and the accounts that you have. Thanks again for listening. We hope you found this helpful.
We hope you've enjoyed this episode of Millstone River Live. Feel free to share it with someone you think might benefit. Millstone River Wealth Management is an independent wealth management firm based in New Jersey. We form a supportive partnership with our clients and help with financial education and planning. We welcome your feedback. Send comments or questions to podcast@millstone-river.com. More information about our firm can be found online at millstone-river.com. Thanks for listening.